Buy-to-let or property development? Which is the best one to focus on if you want to succeed in property? So that's what we'll be focusing on in this video. Stay tuned, and at the end I'm going to explain how you can do both. Hi, my name is Ranjan Bhattacharya. I've been investing and developing properties for the last 30 years. You may have seen me on the hit Sky TV show Property Elevator or attended one of our networking events in central London. If you're new to this channel, make sure you subscribe and hit the bell icon, and you'll get notified each time we upload a new video, which is pretty much 3 times a week. And all this content is stuff that you actually have to watch if you want to be on top of your property investing game. Now, there are lots of things that you can do in property to be successful. The two main activities that people think about are buy-to-let or property development. Now, there are advantages and disadvantages of focusing on each one of those. But over the next year or so, I believe the savvy entrepreneurs will be doing them both in a combined way. And in this video, I'm going to explain exactly what I mean by that. So what are we talking about when we talk about buy-to-let? Well, essentially, we're talking about buying an investment property where you're going to rent it out. And after paying all your costs, and your costs would be things like mortgage costs, repairs, insurances, compliance costs, and all of that, you generate a surplus profit at the end of every month. And hopefully, you repeat that strategy until you build a portfolio which together generates a surplus cash flow to do the things that you want to do. The great advantage of doing buy-to-let is that it produces you regular cash flow. So each and every month you make a surplus on your rental investment properties. So that's pretty groovy.
Groovy, baby!
Because once your property is bought, set up and tenanted, you generate that monthly cash flow each and every month with minimum effort just to keep the property going. The other benefit, of course, is long-term capital appreciation. Buy-to-let is a long-term game, meaning that if you've got to be in it to keep the property, not just for a year or something, but for 10, 15, 20 years. Because over that time, you will experience capital appreciation. In the UK, you tend to find that property prices, on average, tend to double every 7 to 10 years. So holding the property on for a length of time will generate long-term capital appreciation, and each and every month you generate some cash flow. The skill level required is relatively low. As long as you select an area to invest in where there's plenty of rental demand, capital appreciation has got good long-term prospects, and the yield figures actually work okay, you're pretty much good to go. The thing is, there are plenty of experienced property management agencies that can basically do a lot of the heavy lifting for you, so you don't have to get into the nitty-gritty of managing the asset on a day-to-day basis. The other advantage of buy-to-let is the ability to refinance and go again. So what I mean by that, you've got the long-term capital appreciation. Every 7 to 8 years, your property will have increased in value, and you can refinance that property to raise further capital to invest in further buy-to-let properties, and it carries on. So what are the disadvantages of buy-to-let? Well, the main disadvantages is that you need lots of cash. When you get a buy-to-let mortgage, you're typically borrowing 75% of the property's purchase price, so that means you have to come up with 25% deposit. Also, stamp duty is quite high. Remember, if you're buying property which is not your own home and it's a buy-to-let property, you would be paying the 3% additional surcharge on whatever the stamp duty bill is. So that therefore means the upfront costs or the upfront deposits or the cash in the bank that you need to have to buy a £100,000 property is relatively high. And for most property entrepreneurs, that is a key disadvantage, because cash is the fuel of your property business. If you're going to tie that cash up in a property deal, then that's less cash you've got to invest in the next property project. So if you've got a pile of cash and you start investing in buy-to-let, sooner or later you're going to run out of cash. And that leads us on to another problem with buy-to-let, which is the longer payback period. So if you've invested money in a property, your deposit, your stamp duty, your setup costs, your furniture and all the rest of it, it's going to take you years to get that back through positive cash flow alone. And several years to get it back, of course, from capital appreciation, which will obviously give you the ability to refinance. I think the other disadvantage that people look at when they're looking at buy-to-let compared to property development is the operational issues of having buy-to-let portfolio. And what I mean by that is the management. So you've got the broken toilet and the leaky tap issues to deal with. You've also got the costs of compliance. You've got the costs of keeping the properties well maintained and habitable during void periods. And you've got the costs of dealing with tenants who occasionally might not pay the rent and what have you. Okay, let's take a look at property development, pros and cons, and we'll start to put this all together. Now, I hope you're liking this video. Make sure you smash that like button. Also, give me your comments below. Of course, I've just talked about vanilla buy-to-let. There are all sorts of ways of intensifying the profit that you make from a buy-to-let property, but we'll talk about that in future videos. Property development is when you buy a piece of land or an existing property and you're basically redeveloping it into something that it wasn't before. And you're doing that to create an uplift in value. Now, whereas buy-to-let produces long-term stable cash flow month by month from rental income, a key advantage of property development is that you get a massive, pretty much upfront increase in value of the property once you've developed it. So if I'm buying a disused office building and converting it into 7 or 8 flats, you've pretty much increased the value of that piece of real estate by 3 or 4 times. So rather than waiting years or decades for long-term capital appreciation like you would do with buy-to-let, with property development, you identify an underdeveloped site which has potential to add significant value, where you can treble or quadruple the value of the site from the purchase price that you paid for it, and you make that uplift not over decades, but in a matter of months. This ability to generate these quick profits means that if you do it serially, you end up building a cash pot in a relatively quick space of time, as opposed to buy-to-let, which can take you decades. The other great thing about property development projects is the financing angle. And that is, unlike buy-to-let, it's possible to do property development projects with very little money up front, because you can raise that from banks, bridging loan providers, or private investors, or angel investors. And that's because when you're looking at property development, of course, you're looking at an undeveloped site. And it's your vision, it's your skill, it's your experience that tells you what you can do with it to raise its value. So you're taking a site and purchasing it for this, you're going to develop it and make it into this in a relatively short space of time, 18 months or so. So that is a quick uplift in value. When you've got that sort of quick uplift in value, it's possible to get funding for the purchase and doing the work. The proof of the pudding is in the eating, of course. You may have seen me on Property Elevator, the hit Sky TV show. It's a bit like Shark Tank, Dragon's Den. A whole bunch of property entrepreneurs come along on the show and they pitch their property project for funding. And there are 5 of us angels on the show, and if the deal's any good, we offer to fund those projects. Now, if you missed some of those episodes, which features on Sky, you can watch them. I'll leave a link for the box set. You can binge watch all of them. There's plenty to learn from some of those pitches. But all of those projects that were pitched on that show were property development projects. And the reason is, of course, property development projects gives you that uplift in value within a relatively short space of time that an angel investor is willing and able to fund. I guess the disadvantages are that it does require more skill, it does require a little bit of experience to get right, and it can be a little bit more risky. But all of these things can be mitigated with the right training, the right ongoing support, and the right help. It's very, very important that if you're doing any kind of property development, that you get properly educated, because if you make mistakes, any of these uplift benefits will soon turn into losses. We'll get back to the video in just a moment. What is the most exciting opportunity in property right now? And that is repurposing defunct commercial buildings to residential use. Now, most people don't really know where to start, what to look for, and how to exploit these opportunities. And that's why I've prepared 90 minutes of free training for you to get you started on this wonderful journey. You can register for this free training at property-workshop.com. Join me on that free training, and I'll leave you to enjoy the rest of the video. Of course, with property development, of course, you're very much dependent on your power team of skilled professionals to help and guide you through each development that you do. And the other massive problem from a cash flow perspective is that your income, your money, is so bitty. When you do buy to let, of course, you have a regular income each and every month from the rental income. But when you do property development, you pretty much get nothing until you sell the apartments or houses that you're building. So you can go 18 months into a project where you're shelling out money all the time for materials, labour, professional fees and all the rest of it, loan debt servicing, but you are waiting until everything's ready before you can sell the thing. And particularly if you're doing things like flats and things like that, sometimes you have to wait until the whole scheme is built before you can really sell the first unit and get someone to move into the place. The other thing about property developments, which is absolutely true, is that your profit is in the last few units that get sold. If you've got an 8-unit scheme, the sale proceeds from the first 4 or 5 units will all go into your costs and debt servicing and all of that. It's the final few units that you sell, which is where your development profit is. And of course, you have to keep going and doing it forever. People that do buy to let often do buy 4 or 5 properties and stop for a few years to have a little bit of a break, because they've got the regular cash flow and monthly income to sustain themselves. With property development, you do one development, and then if you don't do another one, then you have no income. So smash that like button, it really helps us out on YouTube. And if you're not already a subscriber, subscribe, hit the bell icon, and you'll get notified when we upload new videos. It's pretty much 3 stages to my process. You buy an undeveloped site that you can add significant value to by developing it. You obviously develop it out, and then when you've developed it, you don't sell it on, you let out. So essentially what you're doing is, instead of buying buy-to-let property, you're building your own buy-to-let properties yourself. Now, the great advantage of building your own buy-to-let portfolio is, if you know what you're doing and you do it right, you can keep going forever. And also, you may have a little bit of money, but after you've done each deal, you can pull that money out and you're good to go on the next investment. Now, how do we do that, and how do we fund those sort of projects? Well, first of all, it's about having the skill to be able to spot a site, a building which has development potential. Now, I've banged on about this in previous videos. Right now, over the next couple of years, I believe the best opportunity to find sites with development potential lies with buying existing defunct commercial buildings and repurposing them to residential use. The big advantage with taking an existing building rather than a plot of land and building some new houses on is that it's quick. It's quick and far less risky. The reason it's far less risky is, if I'm building new houses on a plot of land, I've got to go for planning permission, and planning permission is very, very uncertain. If I buy an existing commercial building, I don't have to use planning permission. I use something called permitted development. And there's a fixed set of criteria for getting my permitted development through. And if I know the rules, I'll get that in 56 days, which gives me certainty to the project. The other thing is that if you are developing a bunch of houses in a brand new field, you have got to build everything. You've got to dig foundations, build the walls, put the windows in, roofs, all of this sort of stuff. If you're converting an existing building, the building already exists, and it's just internal configuration that you're doing. It's less risky, it's an easier to manage project, and it's far quicker. This is the whole area we run some specialist training courses on. I'll leave a link to the training course itself, or if you want to turn up to one of our 90-minute taster sessions, you can do so. There's a link down here as well. So what we'd do is we'd typically fund the purchase of an undeveloped site with something like a bridging loan. And whatever the development costs are, you would fund with a development loan. The key thing that you've got to focus on if you're going to build your own buy-to-let portfolio is margin. You've got to make sure that whatever you pick up, there's a 30% margin there. So that means whatever you buy the property for, whatever your interest costs for servicing the bridging loan and the development loan are, whatever the actual development costs are, the stamp duty, the professional fees and all of that, you add up all your costs and then you look at the end value of the scheme that you're creating. There needs to be at least a 30% uplift in value. If you got that 30% uplift in value, that 30% margin, you can perform a little bit of magic. Because at the end of the project, you get a mortgage. You get a mortgage on the development that you've created, and the valuation, the bank valuation for that development will be at its new market value for what you've created. Now, typically, banks don't give 100% mortgages. They're looking for you to have typically 30% skin in the game, sometimes 25%, but the less skin in the game you have, the more it tends to cost you. So I stick with about 30%. So that 30% skin in the game that the bank needs you to have, well, you can either stomp it up from your own cash, but if the deal has got 30% margin in this deal, in other words, you've got a 30% uplift, then you don't need to have your own cash in the game. So at this stage, you'd refinance the property on a long-term mortgage, and if you've got 30% margin, you will not have any money left in the deal. And you'll be producing positive cash flow each and every month from the rental of the units that you've created. The other great thing about doing this is the long-term maintainability of the thing. Now, when you go out and buy buy-to-let property, you don't really know what you've ended up with, quite frankly. But when you build your own, you build them specifically for letting out. So you make sure they're easy to service, easy to repair, easy to manage when things go wrong. And that keeps your long-term costs of ownership and management down to relatively low levels. So there you have it. By doing both, you have all the advantages of doing property development, which is quick cash, if you like, equity generation uplift, and all the advantages of doing long-term buy-to-let, which is that monthly stable cash flow. But by doing them together in this way and focusing on the 30% margin, you can do so in a sustainable and repeatable way, because when you do a deal, you basically aim to exit the deal getting most or all of your money out of it, because you've aimed for a 30% margin. And that means you're good to go on the next one. And that is simply how property developers who are doing this sort of strategy keep going on forever. Now, if you like this video, of course, smash that like button. Let me know what you think in the comments below. That's it for now. Plenty more in future videos. See you guys in the next one. High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.